Markets are still pricing this as a temporary shock, but what we are seeing in the data suggests something much more persistent and potentially more structural. What started as an energy shock is now moving its way through the system more broadly. And that's the key shift to discuss. This is no longer just about oil prices. If we dig in, we're seeing disruptions to shipping routes, transportation costs, and tightening in key inputs like LNG and fertilisers. And that's how energy feeds into price or inflation, rates and growth. And the bond market's starting to react, but not in just a simple way. Yields are rising, but it's not just inflation expectations. So that means it's term premia, uncertainty and compensation for holding duration in a more volatile environment. At the same time, central banks are becoming increasingly constrained. They can manage demand, but they can't produce energy. That means if this persists, we're moving towards higher inflation, weaker growth, and less policy flexibility. We're also seeing fragmentation in a confluence of ways across regions, across energy exposure, and across supply chains. This is no longer a synchronised global cycle. And importantly, some of the traditional relationships are starting to break down. Correlations are changing. For example, gold isn't behaving like a clean hedge. Bonds aren't consistently providing diversification qualities. At times, cash is acting as the only reliable safe haven. And beneath all of this, we're starting to see real signs of strain in the plumbing or the system itself. Increased volatility in sovereign bond markets is one. Reduced ease of trading, early signs of liquidity pressure. And that's a key shift. So markets are not just mispricing the shock. They may be underestimating how far this shock can travel through the system. Just want to say these views are my own and do not necessarily reflect those of the Portfolio Construction Forum or any of its affiliates.